My name is Maisara Shaira BT Misli, and I'm going to present the introduction. In this report, we analyze the financial statements of Mr. DIY Group Berhad to evaluate its financial performance and position using key financial ratios. The retail industry plays an important role in Malaysia's economy, but it also faces challenges such as rising operating costs and intense competition. We selected Mr. DIY because of its strong market presence and its continuous business growth over the years. Our analysis covers the company's financial performance from 2020 to 2024, focusing on 5 key areas, which is liquidity, profitability, asset management efficiency, capital structure, and market value ratios. Finally, based on the findings, we identified the company's strengths and weaknesses and provided recommendation for future improvement. That's all from me.
So, I will present about the background and nature of business of Mr. DIY Group in Berhad. Mr. DIY was founded in 2005 by Tan Yu Ye and Tan Yu Wei. It started as a hardware store in Kuala Lumpur, expanded to mall-based outlets in 2010, and was listed on the Bursa Malaysia main market in 2020. Today, it operates over 1,400 stores across Malaysia, Brunei, and selected international markets. Mr. DIY is a leading home improvement retailer. It follows a high volume, low margin business model with a slogan, always lowest prices. The company sells more than 18,000 products in 10 categories, such as hardware, household goods, electrical items, toys, stationery, and also mobile accessories. Its business strategy included multiple retailer brands such as Mr. DIY, Mr. DIY Express, Mr. Toy, Mr. Dollar, and Mr. DIY Plus and M-Top, while also combining physical stores with e-commerce through an omnichannel strategy. That's all from me. Thank you.
For the next part, I will explain the liquidity ratio, which measures a company's ability to meet short-term financial obligation. The first ratio is the current ratio. It measures the company's ability to pay its short-term liability using its current asset. A higher current ratio indicates stronger liquidity. The second ratio is the asset test ratio. This is a stricter measure of liquidity because it excludes inventory and focus on the company's most liquid asset. A higher asset test ratio indicates a better life ability to meet short-term obligation. The third ratio is the average collection period. It measures the average number of days the company takes to collect payment from its customer. A shorter collection period indicates more efficiency credit collection. The fourth ratio is inventory turnover. It measures how efficiently the company sell and replace its inventory. A higher inventory turnover indicates better inventory management. Next, I will explain the profitability ratio, which measures a company ability to generate profit from the sale and operation. The first ratio is the gross profit margin. This ratio the percentage of profit earned after deduct the cost of goods sold. A higher gross profit margin indicate better cost control and profitability. The second ratio is the operating profit margin. It measures the percentage of operating profit earned after deduct operating expense, but before interest and tax. A higher ratio indicate greater operating efficiency. The third ratio is the net profit margin. This ratio measures the percentage of net profit generated from each ringgit of sale after all expenses have been deducted. A higher net profit margin reflects stronger overall profitability. Next, I will explain the asset management efficiency ratio, which measures how efficiently a company uses its asset to generate sale and revenue. The first ratio is the total asset turnover ratio. This ratio measures how efficiently the company uses its total asset to generate sale. A higher ratio indicates better overall asset utility. The second ratio is the fixed asset turnover ratio. This ratio measures how efficiently the company uses its fixed assets, such as property, plant, equipment, to generate sales. A higher ratio shows that the company fixed assets are being used more effectively to produce revenue. For the next, I will explain the capital structure ratio, which are financial ratio used to evaluate a company level of debt, financing, and its ability to meet a financial obligation. The first ratio is the debt ratio. The debt ratio measures how much of the company total assets are financed through debt compared to shareholder equity. A lower debt ratio indicate the company relies less on debt, result in a more stable financial position. The second ratio is time interest earn ratio. This ratio measures the company ability to pay interest expenses using its operation profit or earn before interest and tax. A higher ratio indicate that the company is better able to meet interest obligation and face lower financial risk. For this slide show the evidence supporting our trend analysis. For the liquidity ratio, the current ratio increased from 1.74 to 2.38, while the acid test ratio improved from 0.42 to 0.68, showing stronger short-term liquidity. Second, for asset management efficiency, inventory turnover increased, while total and fixed asset turnover remains stable, indicating efficient asset utility. Third, for the profitability ratio, the gross profit margin increased from 42.7 to 45.8. However, the operation and net profit margin declined due to higher operation expense. Finally, the capital structure ratio. The debt ratio decreased from 61 to 49, while the interest coverage ratio increased from 7.64 to 10.69 times, showing lower reliance on debt and a stronger ability to meet interest payment. Overall, these results support our trend analysis and indicate an improve in the company overall financial performance.
Assalamualaikum and hi to doctor. My name is Muhammad Zainuddin Zidan bin Abdullah, and I would like to present about Mr. DIY financial strength and weaknesses. For strength, Mr. DIY always use low price strategy. This is because most of the items are affordable prices for all customers. This will attract more customers, especially during difficult economic times. Next, Mr. DIY have many store locations. Their stores are available in cities, towns, and rural areas. Mr. DIY have also wide variety of products. The reason is they sell household items, hardware, stationery, toys, and electrical products. This can help customers save their time because they can buy all of the stuff at Mr. DIY. Next part is Mr. DIY weaknesses. First, Mr. DIY depends on imported products. Most of their products are imported, many from China. Higher shipping costs, a weaker ringgit can increase expenses and reduce profit. Second, strong competitions. Mr. DIY competes with EcoShop, Ninso, and 2 ringgit stores. Competitors can easily copy the low price business model and make Mr. DIY customer move to the other stores. Last but not least, high operating costs. Thousands of stores require high rental, utility, and salary costs, includes Mr. DIY. Profit may be affected if sales decrease. That's all from me. Thank you.
Based on our analysis, we have identified several recommendations that can help Mr. D achieve sustainable long-term growth. First, improving cost efficiency is essential. The company should invest in warehouse automation and digital store management systems. These technologies can reduce administrative and personnel costs while improving overall operational efficiency. Second, maintaining a balanced capital structure is important. Mr. D should continue balancing debt and equity financing. Using a moderate level of debt can support future expansion while preserving shareholder value and maintaining financial stability. Third, the company should strengthen its liquidity management by increasing cash reserves and diversifying its payment channels. Mr. D can improve financial flexibility and better manage risks during periods of economic uncertainty or market disruptions. Next, Mr. D should enhance its digital omnichannel strategy, expanding its e-commerce platform and using data analytics together with customer relationship management or CRM systems can improve demand forecasting, optimize inventory management, and strengthen customer loyalty. Finally, the company should pursue strategic international expansion. Instead of expanding too rapidly, Mr. D should focus on markets with similar consumer behavior and strong demand for affordable retail products. This approach can reduce risks while supporting sustainable profitability. By implementing these recommendations, Mr. D can strengthen its competitive position, improve financial performance, and continue its long-term growth both in Malaysia and internationally. To conclude our financial analysis, Mr. D has demonstrated a strong overall financial performance. The company maintains healthy liquidity, meaning it is able to meet its short-term obligation effectively. In addition, it has shown efficient asset utilization, which indicates that its assets are being used productively to generate revenue. The company also has a stronger capital structure, providing greater financial stability. However, we also observe that both the operating profit margin and net profit margin have declined. This suggests that the company is facing increasing costs which have affected its profitability. Therefore, improving cost management and operational efficiency will be important to maintain sustainable earnings in the future. Moving forward, Mr. D should continue to improve its operational efficiency, maintain a balanced capital structure, and strengthen its liquidity position. At the same time, the company can further expand its digital capabilities and international presence through strategy investment and careful market expansion. Overall, Mr. D remains financially resilient, is well positioned to strengthen its leadership in the Malaysian market while achieving sustainable growth in international markets. That's all from me. Thank you.